Welcome back to the deep dive. Our mission here is, well, it's pretty simple. We take a huge stack of source material, articles, financial reports, all of it, and we just distill it down.
Right down to the pure actionable knowledge you need to be really well informed.
And today, we are diving deep, really deep into the inner workings of a financial institution that is, I think it's fair to say, foundational to the American economic landscape.
It absolutely is. We're talking about Ameriprise Financial.
Exactly.
And, this is a company with roots that stretch back 131 years. It's a genuine American titan that started before the turn of the 20th century. We're talking 1894.
Wow.
And it's just a compelling story. It's one of relentless evolution, massive strategic acquisitions, and, well, the inherent conflicts that come with managing assets on a trillion-dollar scale.
Okay, let's unpack this then. Our goal today is to trace Ameriprise Financial, that's ticker AMP on the NYSE, from its very humble founding in Minneapolis. Then we'll analyze its, frankly, staggering current metrics and its global operating structure. And then, and this is a big part of it, we're going to spend significant time examining the extensive list of criticisms, controversies,
Regulatory headaches.
the regulatory headaches that have followed it throughout the modern era.
And to give you that initial snapshot, this is a Minneapolis-based giant. It's a component of the S&P 500, been public since 2005, and it's really defined by its core business lines.
Which are?
Wealth management, asset management, brokerage, and insurance. They really specialize in, comprehensive financial planning.
But not for everyone.
No, not for everyone. It's primarily targeted at affluent clients who are looking for long-term strategies.
And here's where it gets really interesting. This is where the scope of this deep dive just broadens instantly. We are talking about a company that, based on recent 2024 data, commands U.S. $1.171 trillion in total assets under management.
It's a number that's almost hard to comprehend.
It is. That figure isn't just large, it places them among the largest financial players on the entire planet. To put $1.171 trillion in perspective for you,
Yeah.
you're talking about a pool of capital that is larger than the entire annual gross domestic product of several mid-sized G20 nations.
Like Indonesia or Mexico.
Come like Indonesia or Mexico. It's just, it is simply colossal.
It's colossal. And to understand that sophisticated trillion-dollar structure of the modern Ameriprise, you absolutely have to start at the beginning.
Right.
It's a journey that really takes us from Minnesota farmland dreams all the way to global financial dominance.
So let's start that journey, section 1.
From Investor Syndicate to the American Express spinoff.
The narrative begins, simply enough, in Minneapolis, 1894. The company was founded, but not as Ameriprise. It was called Investors Syndicate.
And the man behind it was John Elliott Tappan. Tappan's original concept was, well, it was focused on providing these certificates that accumulated value.
So like early savings instruments.
Essentially, yeah.
Yeah.
Early savings instruments. It was a very modest start, deeply rooted in the Midwest.
But these early companies, they always seem to hit an inflection point, right? A moment where things really change.
They do. And for Investor Syndicate, that came in the mid-1920s. The firm went through a pretty significant leadership change in 1925. This West Coast businessman, J.R. Ridgway, he merged his investment firm into Tappan's operation.
And he took over.
He took over as president. And look, this wasn't just a simple merger. It was a real shift in dynamic. It brought a new operational focus, a new growth mindset to what was, at the time, a pretty fledgling company.
And the Ridgway family's influence, it became both profound and, frankly, pretty dramatic, especially for that time period.
Very dramatic.
J.R. Ridgway Jr. was just thrust into the spotlight in 1937. This is the height of the Great Depression.
The worst possible time, really.
The worst time. He takes over as president when his father dies unexpectedly from leukemia, and you just have to imagine that responsibility. Taking the helm of this rapidly growing national financial institution at just 23 years old?
23.
That's just a massive display of, significant but premature leadership. And it defined the company's direction for decades. He moved it through the Depression and right into that post-war boom.
And that youthful leadership, it really defined an era of product pioneering. In 1940, while the entire world is focused on global conflict,
Right.
Investor Syndicate introduces something truly revolutionary for the average American investor.
The mutual fund.
The Investors Mutual Fund.
It sounds like ancient history now, I know, but it's so critical to just pause and contextualize this. In 1940, direct investment was risky. It was often completely inaccessible for most people.
Completely.
So what did the mutual fund offer that was so groundbreaking for the client?
It offered two distinct and really powerful advantages that just democratized investing. First, diversification.
Spreading the risk.
Exactly. Instead of putting all their eggs in one stock basket, clients could pool their money. They could spread the risk across dozens, maybe even hundreds of different securities.
Okay, so that's one. What's the second?
The second is professional management. The average person, they didn't have the time or, frankly, the expertise to study market movements.
Of course not.
But this fund, it put a team of experienced professionals in charge of those capital allocations.
Right.
It fundamentally shifted the whole landscape from individual stock picking to, managed savings programs.
And that innovation, it just fueled this rapid expansion, which of course meant they needed a rebrand.
You needed a major corporate rebrand to match their ambition. So by 1949, Investors Syndicate officially changes its name to Investors Diversified Services, Inc.
Or IDS.
IDS.
Okay.
That name change, it really reflects the shift away from just offering these simple savings certificates to providing a diversified suite of financial solutions.
And their expansion, it didn't stop there. They seemed to be focused on building a complete financial life cycle offering.
That's a perfect way to put it. In 1958, IDS founded its life insurance arm. That's the company we now know as RiverSource Life Insurance Company.
And that was a crucial step, I'd imagine.
Oh, it was critical. It cemented their footprint in protection products, in annuities, in comprehensive long-term planning. It ensured they could capture a client's wealth through every single stage of their life.
So by the 1960s, the proof was in the numbers. I mean, the scale of that original product, the Investors Mutual Fund, was globally recognized.
It had grown to become the largest balanced mutual fund in the entire world.
In the world.
In the world. And this isn't just about American dominance. It really demonstrated IDS's powerful position in global retail investment management during that whole post-war economic boom.
And the company became so synonymous with Minneapolis that its physical presence became iconic.
The skyscraper.
The skyscraper.
Yeah.
In 1974, they constructed the monolithic IDS Center, now spelled Center, in downtown Minneapolis. It was a signature building that became, and it still is, a physical testament to the company's sheer size and influence at the time. Okay, so now we enter the phase I like to call the corporate ownership carousel. Because despite this immense physical and financial presence, the era of family ownership was coming to an end.
It was. The Ridgway family sold its final ownership interest in 1979. And IDS became a wholly owned subsidiary of Allegheny Corporation.
That was a big shift. But the real structural transformation, that came just 5 years later, in 1984.
Right, when the global consumer behemoth, American Express, acquired IDS Financial Services from Allegheny.
And this was a marriage of two absolute titans. You have American Express, known for global brand recognition, credit cards.
Travelers' checks back then.
Exactly. And suddenly they have one of the nation's largest financial planning forces right under their umbrella.
So what did American Express bring to the table for IDS? It wasn't just capital.
No, not at all. It was global credibility. It was a massive marketing engine. For 2 decades, IDS operated under that Amex structure, and that led to another crucial name change.
Effective January 1st, 1995, IDS was renamed American Express Financial Corporation, but it did business as American Express Financial Advisors.
Or AIFA, as it was known.
AIFA. That name change was just pivotal. It explicitly tied the organization to the global consumer-facing prestige of the American Express brand.
Which would have immediately enhanced their perceived stability, their trustworthiness with clients.
Oh, instantly. It just facilitated this massive national expansion.
Which ironically just set the stage for the final act of separation.
Right, because after 2 decades, the strategic focus of the two entities, they just began to diverge too dramatically.
How so?
Well, American Express was keenly focused on credit, on travel, on payment services. That was its core. But AIFA was focused squarely on long-term wealth and asset management. They were becoming 2 different animals under one roof.
And that strategic divergence, it finally culminated in September 2005.
Exactly. American Express completed the corporate spinoff of AIFA, creating the independent publicly traded entity we know today, Ameriprise Financial.
And that move was so critical because it allowed Ameriprise to shed that consumer credit focus.
And just aggressively pursue its own strategy in asset and wealth management. It led directly to the colossal size we see today. It was, in effect, a structural rebirth.
And that structural rebirth set the company free. It could immediately pivot toward aggressive growth, unburdened by the, sometimes conflicting objectives of a global consumer payments company.
Which brings us to the modern era.
Section 2, the modern financial powerhouse.
So we transition now from the history to the immediate present and the complexity of its structure. Ameriprise today, it's not just a brokerage. It's not just a mutual fund company.
It's much more.
It is a diversified financial services company and, critically, a bank holding company.
Okay, let's start there. What does that actually mean, bank holding company?
It means they operate under multiple regulatory umbrellas. It means they can offer services that cover the entire financial spectrum, from advice to banking to insurance. It puts them under the purview of the Federal Reserve, not just the SEC. It's a much higher level of scrutiny.
Got it. And despite that diversification, their primary focus is very, very specific. They specialize in retirement-related financial planning.
Almost exclusively for affluent clients. This is not the mass market savings vehicle we saw back in the 1940s.
No.
This is targeted, comprehensive financial guidance. You're often dealing with multi-million-dollar portfolios and really complex estate planning needs.
And their product offering, it just confirms this high net worth focus.
It does. Their core categories include wealth management, asset management, insurance, specifically life and disability protection annuities, and estate planning services.
And the internal data, it just dramatically reinforces this strategic focus. As of April 2022, a staggering 80% of the company's total revenue was derived from wealth management.
And that tells you everything you need to know. They prioritize the advisory, the fee-based relationship above all else. That is the engine of the modern company.
All right, let's put the size into some hard numbers using the most recent 2024 financial data we have. We've already mentioned the AUM, but the rest of the financial sheet is equally immense. Their reported annual revenue was US $17.26 billion.
And those revenues, they translate directly to massive profitability. They reported operating income of $5.258 billion, which yielded a net income of US $3.401 billion.
And their physical and capital resources are just vast. They list total assets on the balance sheet at US $181.4 billion.
And this whole operation requires a global staff of 13,600 employees. This is a complex multinational corporation running on some serious infrastructure.
And we have to return to that defining figure. Total assets under management, AUM, at US $1.171 trillion. This isn't just about size, it's about global standing.
Exactly. And their global recognition confirms this. I mean, within the U.S. corporate structure, Ameriprise is ranked 254th on the Fortune 500 list. That's the standard benchmark for corporate size in America.
And when you break down their business lines, their dominance becomes even clearer.
It does. They rank as the 9th largest independent broker-dealer based on assets under management, but the scope is really global.
So we connect this to the bigger picture.
Ameriprise is firmly ranked among the 25 largest asset managers globally. And some specific rankings give us even more color. They are 8th in long-term mutual fund assets in the U.S.
So the legacy business is still very strong.
Still a powerhouse. And here's an interesting detail. They are 4th in retail funds in the U.K.
The U.K.?
The U.K. That deep European footprint, which we'll touch on with their acquisitions in a minute, it is paying significant dividends. And overall, they rank 27th in global AUM.
So let's delve into their brand and subsidiary architecture, because the name Ameriprise is really just the tip of the iceberg.
It really is. They use 3 principal brands in the U.S. to segment their offerings. Ameriprise Financial is the overarching brand. That's for financial planning, retail distribution, brokerage services, banking. It's the customer-facing front door.
Okay, what's under that umbrella?
Well, you have Columbia Management, which, though it's often integrated, really focuses on the institutional asset management space. And crucially, you have RiverSource.
And that's the old IDS insurance arm.
Exactly. RiverSource is the brand explicitly dedicated to annuities and protection products, primarily life and disability income insurance. This segmentation is just crucial for maximizing regulatory compliance and, targeting specific product demographics.
And the complexity continues with the asset management arm. Since 2015, this part of the business has operated under a unified global name.
Columbia Threadneedle Investments.
Columbia Threadneedle. So that name is a result of integrating 2 massive acquisitions, right? Combining the asset base and the distribution network.
It is. And the Threadneedle part of the name comes from the London-based firm they acquired, which gave them that instant global reach and that big UK presence we just talked about.
And let's not overlook their banking operations. Ameriprise Bank, FSB, was launched in September 2006, so pretty soon after the spinoff.
It offers consumer banking, lending products, personal trust, and related services. But they made a key change. By January 2013, they converted this federal savings bank to a limited powers national trust bank.
Which is a very specific strategic move.
A very strategic move. This conversion underscores their commitment to specialized wealth and trust advisory services. They were moving away from simple consumer banking and toward high net worth trust management.
Okay, so to achieve this massive segmented global scale and this specialized structure, they had to have relied heavily on strategic mergers and acquisitions, M&A.
Oh, absolutely. Especially right after the 2005 spinoff. They used their newfound independence as rocket fuel.
And the M&A spree was crucial for building that global distribution power.
It was. They actually started laying the groundwork pretty early, picking up London-based Threadneedle Asset Management in October 2003.
Before the spinoff.
Before the official spinoff. That move secured their European base before they were even their own company.
Then came the opportunistic moves during a period of just absolute market chaos. In November 2008, right as the global financial crisis was hitting its peak.
Right. Ameriprise made two key acquisitions. They bought H&R Block Financial Advisors for $315 million, which significantly expanded their retail footprint.
Yeah.
And the asset management firm J&W Seligman & Co. for $440 million, which really boosted their product offerings.
Those acquisitions, they just showed a willingness to deploy capital when pretty much all of their competitors were completely paralyzed.
They were. But the biggest consolidating move, that came 2 years later. In May 2010, Ameriprise Financial acquired Columbia Management, the long-term asset management business, from Bank of America for a whopping $1 billion.
$1 billion.
$1 billion. And this single move just vaulted them into the top tier of asset managers. It consolidated their capabilities and added immense scale in institutional business.
But it wasn't just about buying, though. It was also about pruning.
It was. Alongside the acquisitions, they've executed some really significant divestitures. They've strategically streamlined their focus toward high-margin, advisory-centric wealth management.
The first major divestiture came in 2011 when they completed the sale of Securities America, or SAI.
And that was a clear signal. After facing massive regulatory liabilities related to broker misconduct in that SAI subsidiary, which we will definitely get to shortly, they chose to shed that particular independent broker-dealer structure.
And this allowed the core Ameriprise advisors to focus entirely on, I assume, core, often proprietary, fee-based opportunities.
That's right. And the second major move, much more recently in 2019, was the sale of Ameriprise Auto and Home Insurance. They sold it to American Family Insurance for $1.05 billion.
And that sale was really the final nail in the coffin for their non-core, capital-intensive businesses.
Absolutely. Auto and home insurance, it requires huge reserves, high administrative overhead. Selling it allowed Ameriprise to focus squarely on those higher-margin, advisory-driven wealth and asset management segments.
Okay, before we move on, we have to briefly mention their ambitious but pretty short-lived foray into international retail advisory services.
Right, in India. In January 2012, they launched a financial planning division there. They were targeting high-net-worth individuals, which they defined as anyone with an income equivalent to about US $40,000 or more.
So they invested heavily. They set up licensed insurance brokerage entities. They established offices in Delhi, Gurgaon, Mumbai, Pune.
It was a textbook expansion plan into an emerging market.
So why did it fail so quickly?
It was short-lived because of really a fundamental miscalculation about the market's readiness for their core business model.
Fee-based advice.
Fee-based advice. By May 2014, Ameriprise shut the whole thing down. They cited poor prospects for fee-based advisory services in that market at that time.
So it was a culture clash.
It was. In many emerging markets, consumers are just resistant to paying explicit fees just for advice. They're accustomed to commissions being embedded in the product cost. Ameriprise's sophisticated fee-based model was just incompatible with the prevailing consumer culture.
It just goes to show that even a trillion-dollar company can fail when its core competencies clash with local market dynamics.
Yeah.
Okay, so we've charted the history, we've examined the strategic growth, we understand the sheer magnitude of the modern Ameriprise. Now we have to look at the inevitable side effect of that massive scale and that aggressive growth strategy.
The criticism and controversy.
The cost of doing business.
This really raises an important question. What happens when a massive financial enterprise operating across all these complex areas, from mutual funds to insurance to wealth management, what happens when it faces intense, multi-jurisdictional regulatory scrutiny?
Right.
The narrative for Ameriprise is defined by a consistent, high-cost history of significant financial penalties and required settlements, totaling hundreds of millions of dollars.
And it's striking that almost immediately after the spinoff in 2005, a whole cluster of major settlements related to fund oversight began to surface.
The timing is incredible.
It suggests two things. Either Ameriprise's practices were immediately put under a microscope once they left the shadow of American Express.
Or regulators had been building these cases for years while they were still a subsidiary. I think it's likely a bit of both.
So consider the timing. In December 2005, just months after the spinoff, the SEC settled market timing charges. Ameriprise had to pay $15 million.
And at the same time, the Minnesota Department of Commerce levied another $2 million for similar market timing violations.
Okay, for our listener, can we just clarify what market timing means in this context and why it's such a problem?
Yeah, certainly. So market timing generally involves the rapid, in and out trading of mutual fund shares to capitalize on price discrepancies. It often exploits the stale pricing of funds that hold international securities.
And while that's not strictly illegal in all its forms,
Right. When the fund company allows this activity for certain privileged institutional investors, often at the expense of long-term retail shareholders, that's when it becomes a violation of fiduciary duty and market fairness.
so the SEC ruling was implying that Ameriprise was either enabling this or just not controlling this behavior, which was diluting the value for their everyday investors.
Exactly. And the regulatory pressure continued intensely that same month. That NASD, which is now FINRA, hit them with a massive $12.3 million settlement.
And this was for something different. This was related to allegations of giving favorable treatment to certain mutual funds, presumably their own proprietary ones, in exchange for brokerage business.
But wait, there's more from the NSD in December 2005. They levied an additional $12.3 million fine specifically for unsuitable share sales.
So you have a firm getting penalized for conflicts of interest for favoring certain funds.
And at the same time for putting clients into inappropriate products. This was just a clear signal that the regulatory environment post-spinoff was going to be extremely tough.
And the state regulators were just as focused. New Hampshire reached a $7.4 million settlement in July 2005.
And the allegation here was perhaps the most damaging in terms of trust.
Which was?
That the company violated the law by actively rewarding its financial advisors for recommending underperforming in-house mutual funds to clients.
And this is just critical because it strikes right at the heart of the wirehouse model dilemma.
It does.
Okay.
When a firm both manufactures investment products, like Ameriprise does, and distributes them through its own sales force, the Ameriprise advisors, there is an inherent conflict.
The ideal for the client is the best possible product on the market.
But the ideal for the firm is selling the most profitable proprietary product. In allegations like this, they suggest the firm was prioritizing corporate profit by using incentives to steer clients into funds that were not necessarily the best available choice.
And this alleged practice of undisclosed revenue sharing or, selling shelf space, it continued to be a focus. In July 2009, the SEC announced an enforcement action that resulted in a $17.3 million settlement.
And this charge was specifically for receiving millions of dollars in undisclosed revenue sharing as a condition for selling specific real estate investment trusts, or REITs, to their brokerage customers.
This is just another example of a classic conflict of interest. They were alleged to be taking hidden payments from the product provider, the REIT issuer,
in exchange for pushing that product through the Ameriprise network. And here's a key detail. This conduct primarily happened before the spinoff.
But Ameriprise was the successor entity that had to pay the fine.
They had to pay the $17.3 million fine to resolve the matter. The financial liabilities from the American Express era clearly followed the new independent company.
Okay, moving beyond internal fund practices, let's focus on the failures in broker oversight. These led directly to massive investor harm and substantial settlements involving their former subsidiary, Securities America.
Right, SAI. And this is where the numbers become deeply personal for the investors involved. In September 2006, Securities America settled for a significant $16.3 million with a group of ExxonMobil retirees.
And their claim was that they suffered losses due to the company's failure to properly supervise an associated broker.
Yes. When supervision fails, the company bears the liability for millions in losses.
And a similar situation occurred just a few months later, December 2006. An NSD arbitration panel awarded $9.3 million to 3 retired American Airlines pilots.
And they brought a case against Securities America and an associated broker, alleging the gross mishandling of their savings and their retirement funds. These cases just underscore that the failure to oversee brokers who handle sensitive, irreplaceable retirement funds can result in enormous, life-altering losses.
And the complexity and the cost of these failures, it became brutally apparent when they involved high-risk, illiquid products.
Like private placement securities.
Right. These are unregistered investments, often debt or equity in non-public companies, and they're sold only to sophisticated investors.
And Securities America faced massive pre-tax charges related to the sale of private placements issued by these troubled entities like Medical Capital and Provident Royalties.
Can you just elaborate on why private placement securities are so risky, especially when they're sold through a major broker-dealer network like this?
Of course. They're risky because they lack the transparency and the regulatory oversight of, say, a publicly traded stock or an SEC-registered mutual fund. They're illiquid, which means you can't easily sell them.
So you're stuck.
You're stuck. And when the underlying company fails, as was the case here, the investor loses everything. And the broker-dealer often faces huge regulatory and civil liability for failing to adequately vet the product or for selling it to unsuitable clients.
Meaning clients who weren't sophisticated or wealthy enough to handle a total loss.
Precisely.
And the financial consequences for Ameriprise were massive. They took a $40 million pre-tax charge in the fourth quarter of 2010.
Followed by an even larger $118 million pre-tax charge in the first quarter of 2011, just to cover related settlement agreements.
That's $158 million in charges for failures related to one specific highly concentrated area of sales.
And it's really no coincidence that Ameriprise decided to sell Securities America later that very same year. They likely viewed the independent broker-dealer model as just too high risk and too liability-ridden.
Moving beyond systemic failure, we then encounter explicit internal misconduct. In April 2008, the company agreed to pay New Hampshire $3.8 million to resolve allegations that agents at its Portsmouth office committed outright fraud.
And not just any fraud. They were forging clients' signatures on documents to cut corners and increase their income.
I mean, when you hear about agents forging client signatures, that's not a mere compliance error. That is a fundamental breakdown of trust. It's criminal activity occurring inside a branch office of a major financial firm.
It raises some very serious questions about the culture and the internal auditing mechanisms that were in place at the time.
And this problem of failing to safeguard assets, it persisted well into the late 2010s, which shows these ongoing challenges in internal controls and monitoring of their representatives.
Right. In August 2018, the SEC charged Ameriprise with failing to safeguard retail investor assets from theft by its own representatives.
What were the specifics of that theft?
The settlement was for $4.5 million, and the facts were pretty disturbing. The SEC found that 5 Ameriprise representatives committed fraudulent acts over a 4-year period.
4 years.
And they systematically stole more than $1 million in client funds by forging client documents and diverting payments. And the regulatory finding, it focused not just on the fraud itself, but on companies' failure to establish adequate policies and procedures.
So they were ignoring red flags.
They were ignoring internal red flags that should have detected and stopped the theft much earlier.
Now let's turn to internal and employment disputes, which show these conflicts extending even to their own staff's retirement savings.
Yeah, in 2015, Ameriprise settled a class action lawsuit for $27.5 million. And this lawsuit alleged that the company charged its own employees excessive high fees for the funds offered within its own proprietary 401k retirement program.
This is what's often described as a self-dealing allegation, right?
Exactly. Companies that manage their own 401k plan for employees, they have a fiduciary duty to those employees. The allegation here was that Ameriprise prioritized its own profit maximization by using its own higher fee products in the retirement plan over the financial best interest of its own employees.
It just suggests a constant tension between acting as a fiduciary and acting as a product manufacturer.
Always.
And in the employment realm, they face some very serious discrimination charges. In December 2016, the company settled with the U.S. Department of Labor.
They agreed to pay $128,200 in back wages for discriminating against 20 black employees by paying them less than similarly situated white workers. It confirmed a very serious charge of pay discrimination right within the corporate structure.
We also see the continuation of this theme of fund fees, which confirms that earlier regulatory focus from back in 2005.
We do. In February 2018, Ameriprise paid $230,000 to settle allegations from the SEC that it had placed customers into higher fee share classes of mutual funds when lower-cost options for the exact same fund were available.
And this is a common regulatory target. You steer clients into products that generate marginally higher fees for the firm.
Even if the difference seems small to the individual, but over $1 trillion in assets, those small differences add up dramatically.
And we also have to touch on cybersecurity challenges. These just underscore the risks of holding massive quantities of sensitive client data. Back in December 2006, so early in the digital age, the company settled charges related to a stolen laptop.
Just one laptop. And this single physical theft incident compromised sensitive data on approximately 230,000 customers.
That event was a really early cautionary tale for the entire financial services industry. It highlighted the growing vulnerability of client data stored digitally.
And the immense reputational and financial cost associated with even a single compromised device.
Finally, let's look at their response during the 2008 Great Recession, because it provided a strategic insight into their balance sheet strength.
It did. Despite being this huge financial entity, they made a very public and a very distinct decision. They declined an investment by the U.S. Department of the Treasury under the Troubled Asset Relief Program, TARP. And that decision to abstain from the government bailout, it contrasted sharply with many of their peers who eagerly took federal funds to shore up their balance sheets.
It showed a certain confidence in their capital position right after the spinoff.
It did. However, that self-sufficiency, it didn't mean they were immune from market fallout or the need to, restore client trust.
So how do they manage the client trust crisis then?
Well, in September 2008, when the panic peaked and the Reserve Primary Fund, a major money market fund, broke the buck.
Meaning its share price fell below $1.
Right. Ameriprise voluntarily agreed to pay up to $33 million to cover investor losses incurred in that specific fund. Now, they may not have been legally required to cover all those losses.
But it was a massive strategic decision.
It was. It was made to protect client confidence in their firm during a near-systemic panic. It was a trade-off. Avoid the TARP stigma, but pay significantly to maintain those client relationships.
It's a fascinating contrast, isn't it? The company willing to sacrifice $33 million to preserve trust, yet repeatedly running afoul of regulators over these smaller systemic conflicts, like undisclosed fees and unsuitable sales.
It's a huge contrast. So if we synthesize this complex history, we are left with this massive duality that defines Ameriprise Financial.
Right.
On one hand, you have the 131-year-old financial planning pioneer, the firm that started the first balanced mutual fund and really helped democratize investing for a whole generation of Americans.
And on the other hand, you have the modern trillion-dollar conglomerate. It's defined by constant, ambitious strategic acquisitions and a laser focus on high-margin wealth management.
But it's also a company that is persistently defined by regulatory engagement.
We have seen a long, long record of settlements, often large, multi-million-dollar penalties, involving systemic issues like market timing, undisclosed revenue sharing, unsuitable high-risk sales, and fundamental breakdowns in internal controls leading to theft and forgery.
And the sheer volume and the consistency of these regulatory actions, it really paints a picture of a company that's struggling to reconcile its massive scale and its profit-driven distribution network with the fundamental fiduciary expectation of always prioritizing the client's best interest.
So what does this all mean? We've seen that the company built its entire empire on the promise of comprehensive and personalized financial planning for affluent clients. Given this detailed history of compliance issues relating to advisor oversight, unsuitable sales, fund fee conflicts,
We'll have to consider.
we are left to consider whether the complexity and the sheer scale required to manage $1.171 trillion in assets inherently creates a system where client suitability is constantly battling corporate profit maximization.
And is repeated. High-cost compliance failure in the form of, over $200 million in penalties. Is that merely the unavoidable price of being a modern financial titan? Or does this history suggest a deeper, persistent organizational challenge in ensuring every single one of those 13,600 employees acts in perfect adherence to suitability standards across such a vast network?
It's a huge question.
That tension between the imperative for growth and the adherence to fiduciary duty, that is the ongoing story of Ameriprise Financial. And it is something for you, the learner, to analyze the next time you look at a diversified financial behemoth.
A truly provocative and insightful conclusion. That was the deep dive into Ameriprise Financial. We hope you feel thoroughly informed and ready to analyze the next earnings report. We'll see you next time.